Hey, good afternoon, good evening. It is Tuesday, August 26th, and it is after the market's closed. We've had a mixed day on Wall Street with some stocks advancing and then some stocks dropping in price. Nvidia continues to rise going into their earnings tomorrow. So it is priced really high. We'll see how they announce tomorrow. We'll see what the market does. Apple had a good day. Uber had a nice day. Microsoft, Google sold off today. Amazon went up a little bit. There was plenty of green out there. Berkshire went up. Financials went up nicely. The aerospace and defense contractors went up. Eli Lilly had a terrific day today. I think they had good news around their oral weight loss drug. So that looks really good. And overall, I think the market, the volume of trades, I think, is not going to be overly high because everybody's waiting for Nvidia, and that's the only earnings this week. It's not like a really intense week. The market tends to sell off in September, and I think it's going to happen again. And it looks like Zubia ran out of capital for investing in everything, I guess. Yeah, it's good to be patient, as you look at the market. That way, if we have a strong sell-off, you got some capital to work with and you could buy some stocks at better prices. So the market was mixed. Overall, the S&P went up 0.41%, NASDAQ went up 0.44%, and the Russell keeps advancing nicely. A lot of small caps look good, up 0.83%. So it looks good. One of the stocks that announced after the market closed was Mongo. I'm going to take a look at that coming out of. That'll be the first stock we look at. Overall, just focusing on the S&P year to date, the S&P is 9.93 to the positive. Looks good. The 1 year up 15%. Looks real good, especially since we have this real big correction here right in the middle. Went up like 19%, and then it recovered real nice. Lesson that you want to stay invested, but you want to have capital so you can take advantage of events like this. I don't think it's the last one we're going to see. I think we're going to see corrections along the way because we're in an expensive market. It doesn't take much for the market to get spooked and sell off because investors are sitting on really good gains. They're sitting on really high profits, and they don't want to be kind of held or they don't want to hold too long in some cases. So that's what I'm seeing out there. Today was a couple of earnings, not the big giant companies today, but we had Mongo announced, Okta. We'll take a look at Okta. Take a look at the Bank of Montreal, Prudential, PVH. I think this is a luxury brand, if I'm not mistaken. So we'll take a look at that. We'll get started with Mongo. MongoDB is a software company providing a general purpose database. So they do this over the cloud in a software as a service subscription. They had good earnings. They grew at 25%. So the market really liked that. They're relatively a small cap at 17.5 billion. The revenue is 2.1 billion. So your investors are paying about, call it 9 times revenue. And the forward PE is a little high. Analysts think it's a buy with the stock being discounted 35%. When we look at the company and their growth, they're growing nicely. They're relatively small compared to other software companies, but the growth looks really good. Top line growth is going to continue to grow. And profitability, they're going to be profitable for the first time in the fiscal year that we're operating in. So they have a fiscal year that ends January 31st, and we're in the one that they're calling fiscal year 2026. So that's good profit there. Analysts think it is discounted. A lot of analysts cover MongoDB. And overall, I think it's definitely a good business that's growing. But there's some things that, I think I think the stock's priced too high. When I put all those metrics into a valuation, they and let me lower this to 8. I lowered the discount rate because interest rates are dropping, but I put the new trailing 12 months free cash flow in here. Actually, this number is incorrect. And when I have the best cash forecast that I think is appropriate to follow for this stock, and then I discount all those cash flows to today's value, the stock's priced 12% too high. And tomorrow, when they rally, it's going to be over 30% too high. On the earnings per share side, it's 40% too high. And tomorrow, when it rallies, it's going to be mispriced even further. So I think this one here, I'm going to pass on. I don't think it's a good buy. I think there's always other software companies that look better to me. The revenue growth is attracting investors, but there's some things about Mongo that I don't like. The growth is good. Free cash flow is growing. That looks a lot better. Gross margins are good. And we'll see how they do against their big rivals, the Microsofts of the world, because that's who these guys are trying to take market share away from. So for now, I think they're going to have a terrific day tomorrow, up 27%. And we'll see where they settle down. The stock over the 1 year is down 13.44%. It hit a high, really nice stock high of $350 per share, and then really came down. It went from $350 down to $145, and a lot of stocks sold off during the March-April timeframe. And it's tried to pick itself up. It'll certainly have a nice day going up to 273. So it's going to come up to this level and trade where it was trading in February. So investors that are sitting on prices that they bought here are going to get back to even tomorrow. It's a good day for MongoDB. Congratulations to those that own the stock. Hopefully it keeps going up. I just think the fundamentals are a little light. I think I can find other software companies that can give me better value and are going to grow as well. So that's MongoDB. That was one of the highlights in the after hours. Okta is another company about the same size, 16 billion in market cap. They announced and they're up 5.61. So good evening for software companies. These guys, they operate as an identity partner in the United States and internationally. So they do single sign-on software. So when you're signing on and you have a company that has maybe 5 different softwares that you need to log into, with Okta, you can log in once and it pretty much logs you into all those different systems. It helps your employees save time, and it also they don't have to remember like 100 passwords, which would be a big burden on them. So this is something that is working. Now they have to compete against big guys like Microsoft has a single sign-on product. A lot of businesses have single sign-on. It's not a unique piece of software. Okta specializes in it. And they are growing, I believe, their business. We'll take a look at that later. But $16 billion market cap, revenues 2.68. I think they're a little bigger than Mongo. We just looked at Mongo. Analysts do think this one's discounted. This one's already profitable, and the forward P looks a little better than Mongo. The 1 year, these guys are not doing a great, appreciation. Year to date looks pretty good, up 16%, and tomorrow add another 5% to that. So it's going to look pretty good year to date. It's had some pretty good volatility, and it's a smaller company, so that's somewhat expected when you have smaller businesses like this. Taking a look at their growth has been good, and the quarter they just announced, they grew by 12.69%. That's good growth. they're still relatively small, 2.5 billion or so. So that's what's going on there. They have really good gross margins, 76.9. Very good gross margins. And their free cash flow is growing really nicely. Real nice growth in cash flow. 848 million. That is a good cash flow number. And I think they probably are discounted, assuming they don't have a lot of debt. And their free cash flow margin's really good, 30%. Really good. So the market liked what they announced, and it doesn't seem like the stock is heavily, or I should say high priced based on the chart that I just showed. So this stock may be at a good price. This stock's reviewed by 39 analysts. Wow, that's a lot of analysts on one stock. They think it's a little discounted. Looking at their growth rate, they're supposed to keep growing. That looks really good. That's a good growth forecast that analysts have on the stock. Earnings per share looks really good. They're going to expand their profits. So the fundamentals look good for Okta. I'm impressed. I don't think I have a valuation for Okta, but I would venture to guess that they are discounted. Looks like a good company. Let me take a look and just double check. Yeah, I haven't run an evaluation for Okta, but it looks like it's a well-priced stock. It's discounted. It's doing well. It's got momentum. And one of the concerns I have is they're kind of a very specific software, like a one-trick pony, and their competition's tough. They got to compete against Microsoft. All the hyperscalers have their own single sign-on. So if you're competing against those big giant companies, boy, it's going to take a lot to beat those guys. So that's one of the concerns I have with Okta. But congratulations to investors that own it. Looks like it's having a very, very good after-hours session. All right, moving along. The biggest market cap of the day that announced before the market opened was Bank of Montreal, and the stock is up close to 5%, or was up more than 5% in trading. That's good to see. Over the 1 year, this stock's doing great, up 35%. 5 year, man, it's a good stock. So the stock pretty much doubled your money, because when you add the dividend, which is at 3.81, 5 years of dividends at that rate, you're well over 100%. So this is a good stock. It kind of went flat for a couple of years, but overall, it's done well. The 1 year looks great, up 35%, and you get paid a dividend. So this company is a bank. So I like looking at book value as well as earnings per share for banks. And we'll take a look at that. So let's take a look at the book value and see if it grew nicely for these guys. So book value, yep, it grew nice from 64, a book value of $64 per share up to 116 in the trailing 12 months. That's almost doubling a book value over the course of, call it 6.5, 7 years. Very good. Good job. This bank's really creating more value for stockholders. Taking a look at the earnings per share for this company. Profits are expanding, and profits look good. Looks good. Good job, Bank of Montreal. Good stuff. So we've looked at one bank, good earnings. We looked at two software companies, really good earnings. So we're on a roll. We're on a roll. If you want me to check out a stock and you're a member, pop it in the chat. If you're not a member, no problem. $5 super chat. We'll analyze a stock. We'll take a look at the intrinsic value. We will do a complete analysis of a stock of your choosing. Let me know. So the next company is a software company, and they are also doing well in after hours. Look at that. Box Inc. they're kind of a storage company, right? You have an account with Box and you can save all your files online on Box. And these guys, their growth was limited last time I looked at them because it seems like everybody's offering this. Microsoft offers it. They offer it to all their customers. So does Google. So these guys have to compete against some really big competitors. It's a small cap of 4.5 billion, revenues of 1.1 billion. So it isn't too expensive, and P ratio is pretty rational. The analysts think it's discounted by 23%. Year to date, the stock hasn't done great. It's actually down a little bit. Looks like after hours, the stock is up 5.39%. The 1 year, it's up 9.45. So it's in the positive. That's good news, but it hasn't outperformed. I think the S&P was up 15, 16%. So it's underperformed the S&P as I speak. We look at the earnings that were announced. They grew real well. They were growing 6%, 4% for the 2 quarters prior to their earnings. And then the earnings were announced and they grew almost 9%. That's really good. They're a $1.1 billion revenue company. Cash flows are expanding. They should be, because these guys have a simple business. They should be growing their cash flows because they don't have to reinvent their product and spend a lot of capital doing so. And they are looking good on cash flow. And I think that Box will price with a discount because it's got really good margins, really good cash flow. But I just worry that this business isn't going to grow a whole lot. The reason being is, the big players, Microsoft, Google, AWS, they're kind of taking a lion's share and will continue to have what I call a lot of gravity. Customers just will continue to use them. Like I use Google Cloud, or I should say, whatever they call their storage. And I just pay a fee and I'm good to go. And my online storage is on Google, mainly because I'm on Gmail. So I'm good to go there, and I wouldn't buy into Box as a consumer. So, but they're having a good evening. Looks like Shadow Guy's with us. Good to see you, Shadow Guy. And so it looks like Ryanair. Yeah, I flew Ryanair when I was in Europe. We flew we flew into Belgium. And did we fly? I think we flew from Prague to Belgium. And it was a very affordable flight. It was pretty ridiculous. It was either $30 or $40 per ticket. And I thought that was just really low. This is 2019. So really low fares. And I just think, man, how do these airlines make money if they're charging prices like that? But they were growing, I guess. Now they're looking at market cap 32.74 billion, but that's going to go down tomorrow when they open. It's going to open 23% lower. And the other airline in the US it's having trouble is Spirit. Spirit is on its way to being bankrupt. And that's not a very old airline. I think they started maybe 10 years ago, if that long. Yeah, about 10 years ago. And they're kind of on their way to folding up because they're running out of cash. And I think once the word's out there that you're not going to make it, passengers aren't going to book flights on Spirit. They're going to avoid that airline. So these guys, Ryanair, is in Europe, $32.7 billion market cap. And PE ratio is rational, but it's an airline. So you're not going to see high PEs on airlines. I was seeing United maybe 3 years ago. They had a PE of 6. They were so low priced. They had terrific cash flows. They finally rallied in 2024, but in 2023, they were just priced so low. These guys have a rational PE if you compare them against just the average company. Analysts think they're fairly priced, and I guess tomorrow they'll be discounted. Over the 1 year, man, look at this. It's up 55%. Year to date, up 51%. The stock has worked. Can't argue that. Up until tonight, right, where their stock price is going to give up some gains. So I guess their earnings were somewhat optimistic. So why are they selling off? Interesting. Let's take a look at their financials. So there's their latest quarter. It grew really nice, 19.6% growth. So why is it selling off? I don't get it. Good revenue, good growth. Free cash flow, $2 billion. That's okay. On a company like this, I would multiply it times 10. I'd get to like 20 billion. So this thing's priced too high for me. Gross margins, this is where you see that it's an airline. It's very low gross margins. And they are making a profit. Give them credit for that. It seems like they're running a very efficient business. So good job there. So interesting that it seems like they grew really well. Let's take a look at their balance sheet because they may have a lot of debt. Usually these companies have to go in debt to buy those airplanes, but not in the case of Ryan. Looks they got $5 billion in cash and debt is less than $3 billion. So solid balance sheet. This one looks okay. I don't like airlines, but if you like airlines, this one looks like a grower, good top line growth. I wonder why the market is selling the stock off in after hours. They beat and reinforce long term. Well, the market didn't like something, and it's selling it off hard. I am not going to buy an airline stock anytime soon, especially we're in an economy that isn't, I'm not overly like confident in the economy yet. I don't think we're in a recession. I don't think we're headed into a recession, but it's just not going to be a bumper year, a positive year. I think big part of the valuations are being propped up by AI with so much capital being deployed. It's really fueled, especially the big caps having really high stock prices. I'm not interested in buying an airline anytime soon. I think it's more of that's the lane I pick. I don't want to invest in airlines if I can avoid it. So that's Ryanair. Interesting. So Brandon, good to see you. You'd like to look at Stryker, and Stryker is a maker of medical devices and equipment for hospitals. Medical technology company. Has med surge and neurotechnology and orthopedics. Okay. Take a look at their website real quick. Stryker. So we'd like to go to the United States website. All right, perfect. And so they have medical and surgical equipment. Yep. Here's some bed frames. Here's the gurneys. Okay, cool. Lots of hospital equipment and technology. Okay, so that's what they do. Let's take a look at their fundamentals. And on our member call, one of our members suggested that we look a little closer into med device. And these guys officially in med device, they are officially in the med device industry. So I think it was Noam who suggested it. So here you go, Noam. For you and for Brandon, I am looking at one more med device company on top of Intuitive Surgical. These guys have a large market cap, 150 billion, revenue 23.8 billion. Now, why do these guys carry such a high market cap? I think a theory that's grounded on the business model that they're on is when you sell equipment, you'll sell it or you'll lease it to the hospital and create a reoccurring revenue for yourself. When you sell a med device, you could also sell it with a maintenance, contract, a service contract, and those things become attractive because if you have a business that has steady revenue, that's very desirable. And I think Stryker fits into that category. So med device tends to be a positive industry for that reason, that it holds its revenues quite well. All right, so PE is a little high for the current year. 52 is high. 27.9 for the future year. It's rational. I'm not going to say it's low until I look at their revenue. Now we're looking at analysts. They think it's a little discounted. Year to date, this is up 9.5%, right with the S&P. They pay a little dividend, so right with the S&P. Over the 1 year, it's done okay, but it has performed below the S&P. Over the 5 year, it's done well, up 108%. That looks really, really good. Especially this kind of business is pretty solid. It's not like hospitals are going to stop ordering gurneys and hospital beds and all the equipment they need from Stryker. They're going to have a pretty solid business, a very consistent business. And you can see that in their revenues. You see that growth, consistent growth, 11%. That looks really good. Take a peek at the quarterly. Quarterly is nice and consistent. Very good. When's their next earnings? So they just did earnings July 31st. So adding 3 months to July 31st, I guess at the end of October, beginning of November is going to be their next earnings. So we're about, call it 2.5 months from that event. All right. So going back to the financials, they are profitable. Their profits have been coming down a bit. Maybe hospitals are negotiating and getting better prices from Stryker. And I'm not informed on this, but the big bill, I know, took some dollars away from health insurance companies. I wonder if it took dollars away from companies like Stryker. Gross margins are good, 65%. Overall profitable entity. This is a good one we should value or do full analysis. So I'm going to go ahead and do that. Let me take a look at a couple other things and then we'll get into that. So we look at a forecast. These guys are covered by 18 analysts, and the analysts say it's a little discounted. Looking at the forecast they've put together, revenues are going to continue to grow. The growth looks good. They're going to become a pretty big company. In fiscal year 2028, they're going to be a $31.7 billion revenue company. That's going to be a big company. And the EPS, earnings per share, looks pretty rational. Nice growth. Real good growth in that profit. And a lot of analysts are weighing in. So all these things, to me, when you have consistent numbers, for me, I'm more confident in their numbers. I'm more assured that these guys are probably going to do what's being listed here. Numbers aren't going up and down and left to right. No, it's just really consistent performance. And that consistency leads me to believe these numbers are probably going to come in line. Maybe a little higher, a little lower, but it looks pretty good. And I saw your comment, Shadow Guy. We'll go check out Interactive Broker and Google Finance on Ryanair. Okay, so those are fundamentally Stryker. Let's kind of open up a valuation here. I'm going to go for Intuitive Surgical and kind of put it alongside of it, because Intuitive Surgical is a company that does med device. They do more surgical equipment. They also have this really advanced surgical system. I believe they call it the Da Vinci system, where it helps surgeons complete surgeries, gives them cameras and access to really, really small areas of the body that they put cameras into the body. It's pretty amazing what they're doing with technology. And they're probably helping people with their surgeries, which is great. Good stuff. All right. So let's stick to Stryker here. And all right. And I'm going to use a screen you guys can't see to get my data. And we're going to complete a full valuation of Stryker here. All right. Today's date is the 26th. We had a really good call this morning. Wanted to say that we covered like 8 stocks and we went deep on insurance. I came out of that call going, wow, man, we covered insurance big time. And I think it wasn't in today's call. It was on another call that the feedback is, hey, can you look at more med device companies? Because an investor likes them. I go, hey, thanks for the feedback. All right. So I'm going to be looking for some data here. All right, Stryker, how much cash flow are you driving? Free cash flow in the trailing 12 months, they did $4 billion. They've had a nice growth rate on cash flow. Looks terrific. All right, so we're going to trailing 12 months plus the growth. Free cash flow is how most of these investors like Warren Buffett, Charlie Munger, Pat Dorsey, they use free cash flow. Even Jeff Bezos is quoted as saying that they have built Amazon to maximize the future free cash flows that the company is going to produce. So that's how they value their company. That's how they construct their companies so that Wall Street will like the stock. And FYI, just one more comment on Jeff Bezos. Before he started on Amazon, he was an analyst on Wall Street. He graduated from Princeton, went to work on Wall Street, had this really good job. He said, hey, I'm going to start Amazon. He left New York and headed to Seattle, started Amazon. All right, so we've got cash flow growing at 20%. Is that a little too optimistic? Let me think about this for a second. That might be a little optimistic because they're growing at 10, 11%. The growth is going to come down to about 8%. So why don't we go to 12%? That way, we're not being overly optimistic. We are looking at getting a valuation, and we may be investing our hard-earned money. We don't want to invest it using numbers that are too optimistic. It's a bad idea. We're going to look at the cash on the balance sheet, and the cash on the balance sheet is $2,460,000,000. The debt is $17,130,000,000. $17,130,000,000. So that gives us $115 billion of equity value because we took net present value of cash flows, added cash, take away debt. Now let me make sure my share count is correct. Share count, shares outstanding 382. That is not correct. It's 382 million shares outstanding. So based on cash flow, this stock's priced a little expensive by 24%. Now let's take a look at the earnings per share, see what's going on there with the earnings per share. I'm going to use earnings per share for the 2026 year. They are at $15.10. 25 is appropriate. Growth rate. They're going to grow their profits by about 10%. Some go with 8. So it's fairly priced based on earnings per share. I agree with these analysts. These analysts primarily use the earnings per share, and they think it's 8.45% discounted. And this one here is sitting here. Now, I heard an interesting quote, and I heard it from, if you guys follow Josh Brown, he has the Compound. He comes out on CNBC. I like listening to him because I don't invest like Josh Brown. He invests different than I do, but I think he has a lot of good observations of the market. And he said he was talking to Peter Lynch, the great Peter Lynch. And he made it. And I'm talking about Stryker. I'm coming back to Stryker in 1 minute. And he said that Peter Lynch told him, you know what the range, the 52-week range of a stock is? And he said, I don't know, 30%. He goes, you answered just where the market thinks. It's not 30%, it's 100% on a typical stock. It's like, whoa, really? So let's put that to the test with Stryker. And this is what it means is over a given year, 1 year, okay, the low point for the stock was $337 per share. It's hit $400 per share, well over 400. So this one hasn't had extreme volatility. You're dealing with about call it a $70 price variance overall. So you're dealing with about 20 to 25% volatility in the stock price. Where I was going was a stock like Stryker, I think it's a quality business. I'm not against buying quality businesses. I'm actually for it. But I would like to be patient. I would like the market to discount Stryker, bring down the price. Be nice if it brought it down to, $339, and then I could buy it at a discount and accumulate a really high quality company like Stryker. This one may not give us a lot of opportunity. I like this chart very, very much. Remember how stocks sold off in a fury in 2022? This shows that healthcare stocks, med device kind of hold their value better. I like that I think we're in an expensive market. We could see a nice sell-off or crash, in the next, couple months. And this one here, this is a good quality stock. Right now, if you use earnings per share, paying fair price. If you use cash flows, you're paying a little too much. So I would vote for, man, can we get a nice sell-off in Stryker? Can we get it down by 20% and then buy the stock? Because this is a quality business. I'm not against paying a fair price for a great company. So that is Stryker. So it's a good quality business. And they have a little bit of debt. I'm not too worried about it. I'm sure that it's less than 3 times EBITDA. And I'll upload this, all my valuations, to the shared folder on the member folder. And this will be in there in the next couple of weeks. I just did an update this weekend. Hopefully you had a chance to play around with the new data and the new screen that I provided. So that's that one, Brandon. Good quality company. And so is Intuitive Surgical. They're just priced a little too expensive. And those are two good companies. Whenever we see good businesses like this, man, the stock market discounts them, it's an opportunity because these really hold their value. All right. So hope you found that interesting, Brandon. Thanks so much for the suggestion. Looks like we've got more people on the stream. How's everybody doing tonight? And looks like we've got Carlos. Good to see you, Carlos. And is it Cartel Raider? Good to see you. Mohammed, good to see you. Zubio, John, thanks for joining, guys. All right, so it looks like Ryanair is different data is being shown on different platforms, which is weird. The earnings on Ryanair seemed really positive. They didn't match the price action. Look at that. After hours, flat. Huh. So, yeah, I don't have Interactive Brokers. I'm not going to go there, but I can go to Yahoo. Let's take a look at Yahoo. Guess Yahoo will be the tiebreaker. It's good that you're looking at different sites because sometimes, these websites use these lookups and sometimes the software just doesn't get it right. Yeah, after hours, we're not seeing any move. And but on stock analysis, it's showing a big move. So I think interactive brokers, Yahoo and Google, if you're getting three sources that are saying it's not moving. So not sure if right now I'm I'm betting that this is probably going to refresh and it's going to be close to even, because according to these headlines, I'm seeing that they had a good earnings. The revenue was really good. They actually um, accelerated their revenue growth. So I would agree that maybe we got to question this update. I'm sure you can go into stock interactive brokers and see if you can buy in after hours and see if it presents a price. All right. So Carlos, how are you, sir? You want to look at GTLB? Yeah, let's take a look. So GTLB, GitLab. Now, was this the company that Google was trying to acquire? GitLab. Yeah. So it's a development lifecycle. So when you want to develop a piece of software in a team, maybe some developers here in the United States are going to work with some developers in China, India, and you can work in this GitLab software and develop a piece of code. Now, what they may be dealing with is a lot of people think AI is going to disrupt the development of software, make it super easy, eliminate jobs. And it looks like that's a story that's hurting the stock. Wow, man. that's not looking good. You know, what'd be interesting is we're going to keep looking at this. And wouldn't it be interesting if GitLab revenues are growing? And it seems like the fundamentals show a company that's flourishing. So let's keep doing that before I form any conclusions. They're going to announce earnings next week, September 3rd. And their stock is rallying. If you guys joined it after I started, we looked at MongoDB and Okta, both are software companies, and they both had really good earnings. Even Box, which is another software company, had good earnings. But MongoDB had really, really good earnings. And let's take a look at this one, because this might be an opportunity. The market may have the wrong story. So $7 billion market cap, revenue is 804 million. So you're paying, call it 9 times the revenue. Not bad. And PE, only 544. Must be the next Palantir. But forward P is only 55. All right. Analysts think it's discounted by 46%. All right. Drum roll, please. So, hey, stock market. These guys are not getting disrupted by AI. Where do I write my congressman? The Congress of Wall Street. Because look at this growth, ladies and gentlemen. This is terrific growth, 29%. What is going on, stock market? Why are you beating down a stock that's growing 20? We just showed MongoDB. Let's show MongoDB again. We need to show Mongo, show you the difference or the similarities. So we got this stock. It's up 29% in after hours. And they're growing at 22% trailing 12 months. They put up a beautiful number, 23.7 revenue growth in the latest quarter. Now, the reason I say that, this is a software company. Okay, perfect. This is a software company. All right. This is growing at 29% trailing 12 months. Okay. Those are solid growth numbers. Those numbers do not tell me this company is being disrupted. Those numbers tell me the market doesn't have the right story. Okay. It's kind of trying to prosecute the wrong suspect. Hey, this is innocent bystander that was just hanging out in the AI neighborhood, and it's now being prosecuted. You're going to get replaced by AI. Well, they're just growing their business, doing a really nice job. 88.6% gross margins. This is a quality, desirable business if you look at those margins. If they continue to get bigger and bigger, and I believe this is the business Google wanted to acquire. I forgot why they decided not to acquire it. Probably because they already have enough problems with the Department of Justice. They proved that they were a monopoly, thinking of breaking them up or putting limitations on them. They probably thought, hey, we got to stop acquiring businesses for a while. We got to get the Department of Justice off our backs. Then we'll acquire businesses. All right. Free cash flow isn't terrific, but I'm not worried about that. Why? Because I have 88% margins to work with and a growth rate of close to 30% to work with. Those are fantastic numbers. And, it's a little bit of a, contrarian thought. I think the market has this stock wrong. Let's value this stock. And I would say that next week, September 3rd, is that Wednesday or Thursday? I think it's Wednesday. And I think these guys look really interesting. Let's put them into a valuation. We're going to put them alongside another small software company. Who should I put them alongside? Let's see here. Let's put them alongside Adobe, because Adobe wanted to acquire Figma. And Figma does something similar, but different. Figma gets people to collaborate, and it could be for a marketing program. It could be all kinds of things, different types of projects. And our friends at GitLab, they're software. They're kind of, if you want to develop software or something like that, you can use GitLab. So it's similar, but different. All right, this is a good one. And I've been storing all these valuations, creating a huge repository of valuations, a lot of small caps, because that's what this community of investors is all over, these small caps, trying to find the next small cap that's going to be a big cap. And take your capital, multiply it times 10 or 20. Hopefully the latter. All right, this is a smaller business. I haven't looked at their balance sheet, but for now, I'm going to 8.5. Actually, I'm going to 9. I want a higher rate of return because I'm taking a higher risk. Now, let's take a look at some numbers here. Now, this is where we need to put our thinking hats on. Investing is an art and a science. The science of adding, subtracting, doing the arithmetic and modeling, that's science. But the art and really the skill is being able to address some of those gray areas. And GitLab is in that gray area. So this has got terrific margins. It's growing. Top line revenue tells me customers like GitLab. They like it a lot. So much that new customers are going to GitLab. And the existing customers are buying more seats of GitLab. They're doing more projects in GitLab. And the market may be, telling themselves, and it's probably a bunch of journalists that don't really know the software development, environment. They're telling themselves, well, AI is going to disrupt everything. It's going to do everything. And these numbers are telling me a different story. And I believe numbers more than people. Nothing personal to those journalists, but numbers are numbers. Having said that, I'm now going to construct a free cash flow forecast using the change in the free cash flow numbers. I'm also going to look at the quarterly, because these margins are so darn strong. Understand that when you have gross margins of 88, 89%, you're keeping almost 90 cents of every dollar that you sold. And then you have, if you're efficient in your operations, you can keep a big part of that. Right now, they're probably putting it back into the business, making themselves bigger and bigger and bigger, which is the right thing to do. Keep growing. So let's take a look at the quarterly and come back to that free cash flow. Look at that beautiful number, $105 million. Just, it's like a diamond coming out of the ground. 62 million. So it's easy to construct a free cash flow forecast. These guys can put up quarters with free cash flow. They had a bad free cash flow number there, probably because they had to interject some cash into the business. This is a growing business. I'm fine with that. I'm going to take the 6 month and I'm going to work with that. So this is 217 million is their free cash flow number for the 6 months. Now, I'm not going to be overly optimistic on that number. I'm going to take that number, 217. I'm going to multiply it times 0.75. So I don't think I've typed in correct here. Give me a second. That's a little better. And I'm not going to grow the first year. Now, these guys are growing at 30% top line. Their free cash flows are really going to expand because once they get to a certain size and scale, then the margins support a very fast free cash flow number. So I'm going to go with a 25% growth rate and then a 5% growth rate here. Okay. And okay. This is a conservative forecast. That's fine. Now I'm going to use a different screen over here and get some more data so we can complete GitLab, starting with our shares outstanding are 165 million shares. Nice. Okay. Now I'm going to look at cash and debt balance. We don't like companies with too much debt. That means that they have a lot of debt to serve versus just trying to grow their business. And these guys are fine. They have $1.1 billion and they have debt of 300. They have 300,000. So yeah, they don't have any debt. So we have a company that's worth $7 billion, according to my calculations here. They are priced at, the market cap is 7.2 billion. So they are accurately priced based on the forecast I just put together. Okay. Now let's take a look at the earnings per share numbers. We're going to look at the year that they're operating in, which is their fiscal year ends January 31st, 77 cents. Now, I like this business. It's a growth business. It's growing really well. And earnings per share are going to expand at 20%. So this business is priced fairly. And even with that negative story, what's interesting is this is still fairly priced. Now, this is not pulling me in. I expected that, if we found that this thing offered me a 40% discount, I'd be like, hey, I'm going to go buy some shares, or I'm going to consider buying some shares. But this is not compelling. I know of other software companies that I am buying that have more compelling entry point. But this is a very interesting company because as we let this company operate, if we keep seeing that they keep growing, we keep hearing these stories that, AI is going to really disrupt the software development, area, business, or I should say occupation. then we can kind of compare it to the actual data we're seeing from GitLab and maybe start to question or disprove that theory that a lot of journalists are repeating. Oh, AI is going to replace a lot of the developers. I don't personally believe that. I think that AI is neat, but I think AI makes errors. Just use AI consistently. You'll see that it gives you at times, what do they call them? Hallucinations. Gives you bad data. And it's like, so you want code that's going to have an error here or there? That's a bad idea. Remember how CrowdStrike brought the world down to its knees? You don't want that. Okay. So yeah, you can use AI to make a human a little better, a little faster, a little more efficient. But just a wholesale change of having people do quality work and replace them with machines, I would bet against the machines. Right now, I would say I'll take the humans. Thank you very much. Carlos, thanks for bringing this up. I'm going to store Stryker. That's right. I got a note to add Stryker and GitLab to this watch list. Whoa. Google is a little slow updating my sheets. So I want to remind myself to update Stryker and GitLab. And I'll do that on my own time. Thanks for asking about that, Carlos. That was an interesting thread. And I want to watch this again so I could see what really is happening to this company. Is AI all fluff and no muscle? Is it really going to replace these jobs, or are journalists just looking for or analysts in some cases, some AI bullish analysts are like, oh yeah, AI is going to do all these things. This stock is rallying probably because their friends at Mongo and Okta are having good nights, so they're inviting GitLab to the party, the after hours party of seeing their stock price go up. So thank you, sir, for that one. So I'm going to guess that you're in the software development space because you're using this software. You're also using Hubs. Never heard of Hubs. That's a pretty cool name, by the way. Hubs. HubSpot. I have heard of HubSpot. HubSpot is in the CRM space. Marketing. Okay. Yeah. I have heard of HubSpot. I haven't ever personally used it. I've heard about it. Here's HubSpot. Okay, cool. And where do market teams go to grow? So this is like a marketing software, huh? Okay. So this is in the CRM. It was kind of labeled as customer experience, CX. And marketing is within the whole CRM CX space. You know, you market to get prospects, and once you get them closed as a customer, they're a customer. So these guys are in that ecosystem. And let's take a look at their growth and so forth. Now, the 800-pound gorilla in this space is Salesforce. That's the one that has the biggest, most mature CRM platform out there. These guys are 24 billion. Revenue is 2.85 billion. So paying about 9 times revenue. Forward P is 43. Analysts think it's a very discounted stock. Again, these businesses are dealing with the stock market saying, yeah, you know, HubSpot, AI is going to replace everything. And I'm kind of exaggerating what I hear, but let's see where the revenue lands on this one. See if AI is disrupting it. Nope. They're growing at 19%. That's pretty good growth. Now, it's naturally declining because as you have a bigger number and you have these bigger compares, you're not going to stay at the same growth percentage. You're just comparing against a higher number. But the overall growth of 19% looks good. in the trailing 12 months, and the last quarter grew at 19%. So this business is looking like it's growing. Customers like HubSpot. More customers are becoming more companies are saying, "Hey, we want to be HubSpot customers." They like the software. They're willing to take price increases, which is how they grew at 19%. So this is looking like a healthy, growing business. Perfect. Free cash flow. Beautiful. 626. Look at that. Look at that growth. That's what I'm talking about. Margins, 85%. All right. Good looking company. Fundamentals look really good. So we got good fundamentals there. Checking on the balance sheet. Make sure we don't have problems there. Nope, no problems. Lots of cash. Looks good to me. Let's put it into a value it through a model. Hey, look at there. There's Salesforce. Salesforce is the 800-pound gorilla in the space. Maybe they'll acquire HubSpot someday. All right, so I'll just go ahead and use this as a template, and we'll knock out HubSpot. All right, so it's a smaller business, but not quite as small as our friends at GitLab. So I'm gonna go 8.5. GitLab, if you recall, was like 1 billion in revenue. These guys are 22.4 billion. So they're getting bigger. You saw how smooth their cash flow was, nice and smooth and growing. So I'm going to give them a little bit better discount rate because I think they deserve it. All right, like I did before, I am going to open I'm going to view a different screen you guys can't see so I can update data quickly. So let me change my share count. These guys have 52.69 million shares outstanding. Their free cash flow looked terrific. 629 over the trailing 12 months. And so 626. And we're going to add the growth rate that we're growing by. I'm going to change the growth rate in a second. These guys are growing roughly at 20%. If I look at the growth in cash flow, man, they moved that cash flow. They basically tripled the number in 4 years. Now, as they get bigger, the growth isn't going to come as easy. But I think it's I think a good number would be I think 25% is fine. 5% is fine there too. I don't like that number. It's too high. It's being too optimistic. We're putting hard dollars, money we worked hard to make. So that's the intrinsic value. They had a good cash balance on their balance sheet. Let's take a look at that and add cash. They had $1.67 billion in cash, and they have 280 million in debt. And that was their share count. That does not look right. Did I put in some data incorrectly? So shares outstanding. So this number's not right. Well, that's because I haven't updated this. User error. All right, now that's looking a little better. All right, so we got a 21% discount on this. I like to go conservative because then I don't get like happy feet, like, oh yeah, this looks great. It's like, all right, cool. 21% looks okay. The market probably has them wrong. Like, oh yeah, market's going to eliminate these guys. Now let me take a look at their earnings per share. We're going to update that section of this model. And the earnings per share is going to be $11.63. That's a really big number. Holy smokes. All right, 36, they're growing. Yeah, that's fine. And the growth rate on that number. So I'm going to change that to 15. So HubSpot provides a 16% discount on their stock, according to my analysis here. And that isn't overly exciting to me. And not to say anything bad about the company. I'm glad they're doing well. They're growing their revenue. These guys did have, look at this stretch here. Wow. I think they IPO'd and they just took off. And then the market sold them off. In 22, everybody sold off. And then it's just been going up and down. More recently, it really has gone down hard. Now, the market may continue to sell off software stocks because the market really loves hyperscalers, utilities, semiconductors that are in the data center, and it's neglecting companies like this. So where I'm going is I'd like to see a better proposition as an investment. 16% isn't all that exciting because I can buy Salesforce for a 31% discount. And I know what I'm getting here. You're getting the dominant number one player in CRM. So I'm not going to buy a less proven company at a 16% discount. You'd have to offer me like 40% discount if I'm going to buy it ahead of Salesforce. I'd rather buy Salesforce. I know what I'm buying here. I think Salesforce is terrific. Really proven business. It's caught up in that negative story of AI is going to replace them. HubSpot looks really interesting. If it keeps selling off, maybe this thing will get to a point where it becomes compelling. But that's the discount I'm coming up with, Carlos. So hopefully you found that interesting. And I'm going to go ahead and remind myself to update this on my free time. So good one. Thank you, sir. Hopefully you found that interesting. So KCJP, Kristen from South Texas. So I spent a couple months in San Antonio. Just want to say that the people in San Antonio are really friendly. Nice people, down to earth. I live in Southern California, and the food was tasty. I probably ate too much brisket, but boy, it tasted good. Good to see you, Shadow Guy. Shadow Guy uses GitLab. So GitLab's increasing prices, huh? Ooh. Mike, the dividend investor guy. How you doing, sir? Yeah, good to see you, Mike. And it looks like Michael Anthony, good to see you. Cartel Raider, good to see you. I've never used, I never used GitHub. Wasn't it GitLab? GitLab. And that's a world that I've never worked in. So interesting. You guys have used the products. Cool. Man, a lot of posts. Good job, guys. And then Mall Tiki, Texas. You want to look at Lululemon, $5 super chat, and I can look at it. Just if you're a member, I view these tickers, just part of the membership. If you're not a member, I charge $5 just to make it, part of the program. If you pay your monthly subscription versus if you just come on the stream. I'm happy to look at it with a $5 super chat. So think about that. Thanks for attending. Appreciate it. Ben 10, good to see you. I am doing well, sir. SoFi's looking good. Glad to hear it. So, Michael Anthony, what do you think on the news drug stocks on Monday? So, was the news that I heard was Eli Lilly's oral drug is going to go forward, and they did have some success with it. But what other things did you hear out there? Yeah, you're welcome, Carlos. You are welcome, sir. Man, we covered some good ground today, guys. We went into software. I'm glad we've gone into software because I think software is being beat up, and you're seeing some good discounts on software. And I don't see that these software companies are losing revenues. It's not like AI is replacing them, but the whole theory is out there that AI is going to replace these guys. And I think in some cases, these companies like Adobe, Salesforce are going to use AI, are going to create products that are AI driven and then sell them to their customers. So they're actually going to benefit from AI. That's my theory. And we'll see. We'll see. All right, guys. So we covered the earnings announcements. I think there was a couple others. So we went over the main ones. PVH is apparel company in the United States. The company operates through Tommy Hilfiger. Okay, cool. Familiar with these guys. So an apparel company. They announced earnings. 5% rally. Look at that. Cartel Raider becoming a member. Man, look at this icon here. Is this you? Is that Virginia Tech? Thank you so much. Good to have you as a member. Please email me at Victor H Investing. I'm going to put my email address here at Gmail. And I'll get you set up with all the member perks, get you on the shared folder where I share this analysis as well as the model itself. You'll have a working model and all kinds of stuff. Give you access to the Discord, and I'll get you invited to the member calls, and also on live streams like this one. If you had a ticker, be happy to analyze it. And one of your favorite players is the image, huh? Virginia Tech. Man, I am ready for football season. I enjoy watching football on weekends. It's a brutal sport, but I hope nobody gets hurt, which is kind of near impossible. But it's just incredible games, man. And grew up in the United States, and football was always like the big sport in my mind. I also like baseball, basketball, and others, but football is my favorite sport. Looking forward to college and the NFL starting, but I'm more of an NFL guy. But Virginia Tech, remember Michael Vick at Virginia Tech? Boy, he was awesome. All right, so thanks again, Cartel Raider. Please get me your information over email, get you all set up. So what am I expecting tomorrow from NVIDIA? Oh, man. I'll go ahead and put it out there. I think it's going to sell off after they announce earnings. The stock has just been rolling higher, leading to their earnings. And I'm like, wow, the market just loves NVIDIA. Look at this. Woo-hoo, man, that is incredible. Go NVIDIA. And I think it's going to be kind of a dose of reality when they look at the earnings and then they start forecasting like, okay, in order for them to have this stock price, they're going to have to grow like they're growing for the next 10 years. And there's another thing I heard recently that made a lot of sense to me. When we talk about the stock market, right, and we look at how well And the S&P doesn't tell you the whole story. Maybe the NASDAQ is a better story around tech. So the NASDAQ's just gone on a tear, right? In the last 2.5 years, up 105%. Around AI, the market already knows all the good news. You're not going to surprise the market and go, oh, you didn't know that AI is going to also do this, and AI is going to create robots, and AI is going to do this, and AI is going to do that. And with NVIDIA, you're not going to surprise the market and say, oh, you forgot the use case that, you know, I don't know what use case to put out there, but all the use cases around robots and business automation, all those things are already pretty much well known by the market. On the flip side, there could be surprises. Like Sam Altman, stated that, hey, there's some businesses that are real around AI, but there's some businesses that are unreal. So there is a bubble in AI. He stated it. He stated it this past week. And that really made people nervous because it's true. I mean, for people to rationalize that, all businesses out there for AI are real. Okay, that's irrational. Is it rational to think NVIDIA is going to keep their revenue where it's at? To me, it's irrational because they're a semiconductor company. They're supposed to be cyclical. So if, I'll answer your question, Carlos, and feel free to laugh at me if I'm wrong, which is, I think it's going to sell off. So you can show up to the live stream for the watch party tomorrow, and you can check it out. All right, so Cartel Raider. You want to look at Rapid7 cybersecurity, small cap. They use AI with their products. Let's take a look. Never heard of Rapid7. So there it is. So Rapid7. Wow, sold off. Sold off for the 1 year. Okay. All right, so Rapid7, let's take a look at their website. I like getting my head around a business. Like, okay, what are they trying to do? What's their proposition to the market? So these guys are security built to outpace attackers. Okay. All right. Cybersecurity. We've got some companies that are using it. Okay. Okay, cool. Got it. So let's take a quick tour around. I think it's Rapid7. Why is it not finding it? Rapid7? RPD. Okay. All right. So see, these software stocks are rallying in after hours. Market's waking up to, hey, these small cap software companies, thanks to our friends at MongoDB and Okta, are causing a little rally. All right. $1.3 billion in market cap. Revenue, $855 million. So they have profit, and the forward P looks really good. Analysts think it's discounted. We just went over how these guys have been sold off. Okay. Let's see if that's warranted or if the market is not treating them fairly. Okay, out of the gate, these guys are a small business, right? Or compared to, CrowdStrike and Palo Alto and Fortinet and those companies, these guys are relatively small, less than $1 billion in revenue trailing 12 months, and they don't have a lot of growth. When we look at let's look at Fortinet. Fortinet's growing at 14.46%. They're a $6.3 billion revenue company. So you see that this is a faster growth rate, a bigger company. So coming back to Rapid7, smaller company, lower growth percentage, which is a bad sign. So the adoption rate of Rapid7 isn't isn't high, and they can they run the risk of being irrelevant. Like they get ignored by the marketplace. The marketplace is buying CrowdStrike, Palo Alto, Fortinet, Zscaler. There's players out there, right? Including like Microsoft has cybersecurity software, and so do the other big software companies. So that's one thing that I would say. This is a yellow flag, could be a red flag. Like, okay, let's be careful with this. That's probably like the market's selling it off. It's rational. Like, hey, these guys aren't growing. That could be a problem. Okay. So let's take a look at other things that give us a sense of the value and desirability of this business. They are producing good cash, $180 million. Looks good. Gross margins are good. Okay. All right. Now, I'm not afraid to buy stocks that are going to do a rebound, like a Zscaler. This was a good one. Zscaler is in their space, and Zscaler was not doing much, was being sold off. I thought that it was being misunderstood, and I thought they were going to do better because their growth rate was there. I thought they were going to recover their profits, and boom, this thing really took off. So it took off with me owning shares. It was a success story on Zscaler. So I'm not afraid that if I understand the business and I'm buying value and I'm getting at a really good price, I'm good to go. Zscaler is bigger. It's a bigger revenue company, and market cap's 42 billion. So we're dealing with a different size company. Let's get back to Rapid7. So this looks good. The free cash flow at 180 million. The business is discounted. We're going to do a full valuation. But the most important question that I would say the homework item I would leave you with is study the business, and you need to form your confidence in them being able to grow. If you believe they're going to grow, it's a good idea. If you don't believe they're going to grow, I wouldn't touch it, because I don't want a company that's going to be irrelevant. It's just going to sit around and not make much appreciation. So that's a homework item for you, is get really familiar with them. And if you think they're going to grow, it's an opportunity. Not grow, not an opportunity. Might be just a troubled company. That the software isn't competitive. The software isn't liked by the market. They have a little bit of debt, not too bad. They have net debt of 455 million. Not too bad of a problem. No worries. So let's get into evaluation. Got plenty of cybersecurity stocks to compare these guys to. I'm going to go near, I kind of have companies grouped together. Here's CrowdStrike, Zscaler, Fortinet. These guys are security. Palo Alto. Let me put them next to Zscaler. See if some of that Zscaler good luck rubs off on Rapid7. So cybersecurity, and I like showing that I'm looking at multiple companies. One thing that I will state is it's not like you have a dominant player. You have competition amongst the cybersecurity companies, and these tend to replace each other every 5 to 10 years. The leader of the pack is changed. Somebody comes out with a better way of doing security, and the pecking order changes. That's just what happens. That's what I've observed. All right, so this was RPD, I believe. Rapid7. This is a small company. I'm seeing that their revenue is declining, going up to a 10, taking a risk potentially. I'm like, hey, I could buy Fortinet, a nice, well-known company, and I don't know why this is not updating. Google's got to pay their power bill because they're not updating my. There we go. I could buy a Fortinet at 37% discount. I think this is going to be a good rebound story. This is a well-known company with very good cash flows. So I'm not going to invest in a small company that is a higher risk unless you give me a better rate of return. So I'm going to a 10. That's how we control. If we take a bigger risk, we want a better return. If we're going to get the same level of return, I might as well go with the lower risk option. All right, so RPD, we're going to go back. I'm going to use a different screen and get the data that I need to do this valuation. We've got 64 million shares outstanding. Got that in there. They had a good free cash flow number. They're not growing their top line very well. They are growing their free cash flow, but that top line is going to limit free cash flow. If you don't grow your business, that cash flow is going to stay static. So let me update this field first, and then we'll get back to the growth rate. So 180. And they're growing at 5%, but their cash flow growth rate was a little better. So I'm going to go 10% year one, and then we're going to go with 7% years 2 through 4, 5% in the future because they're small. And they're going to have an intrinsic value of 3.8 billion. Okay. Cash was $511 million. And the debt was $967 million. So this is looking good. Okay. Earnings per share. And I forgot to show another screen, but their forecast is they're going to keep growing at like 4%, which is in the software business. I mean, that's just not exciting. They should be growing faster. But their earnings per share is $2.20. And they're getting a 12. The reason for that is that they're not growing. And so this gives me an attractive valuation, but I still don't like it. And the reason for it is it's going to take, in order for the market to change its perception of this stock, is for it to change its growth rate, its top line growth. If it doesn't start growing its top line revenue, this thing's just going to be bumping along the bottom. And it has to grow its revenue. If it can grow its revenue, rock and roll, we have a discounted stock. Okay. But it's a risky stock because no growth, no appreciation. That's just the way the market's going to be. In technology, you have to grow because if you're not growing, your competitors are growing, like Fortinet's growing, CrowdStrike's growing, Zscaler's growing. That means they're taking share away from you and you're tiny. So you're going to become irrelevant. So the numbers show that, hey, discounted, man, if they could start growing at 20%, this is going to be a really good opportunity. But for now, for me, it's not investable. Cash flow, the revenue growth is a big showstopper for me because I have choices. I could buy Palo Alto. They're growing. It's fairly priced. I can buy Fortinet. It's growing. It has a discount. I can buy Zscaler. Well, I wouldn't buy it because it's priced too high now. I had it and I sold it. I made money. And or I could buy CrowdStrike. So as investors, right, there's no rule that we have to buy only one stock. We can look at, okay, within cybersecurity, which one's the best deal? Which one is going to get me the best rate of return for the lowest amount of risk? And this one here just it's got too much hair on that top line revenue growth. If we can grow that revenue better, we got something. We can't grow that revenue. At best, this thing's just going to be a value stock that doesn't go anywhere. So thanks for asking. That was a real good one. I'd never heard of Rapid7, but once you get access to the shared folder, you'll be able to see the valuations on Fortinet, Palo Alto. You could see Zscaler, CrowdStrike. You can get your head around those. These guys are priced too high, in my opinion. They have good revenue growth, but they just have really sky high stock prices. And remember what I was talking about earlier, right? Look at Zscaler. Same company, priced very differently. At one point over the last 12 months, you could have bought the stock for $155. And the same year, you could have bought the stock for $316. Well, easy to show that if we could just find good quality businesses and be patient and buy them at the right time, we make money. So discipline, research, having good analysis, really understanding, is Zscaler going to grow, or in your case, Rapid7. If Rapid7 starts to grow, please come back and tell me, because I'll be the first one to be like, all right, cool, this thing's moving, this thing's going places. They got to start organically growing. Thanks so much for being a new member, and keep the questions coming, sir. Will, thank you, sir. $5 super chat. Which stock did you want me to look at, Will? Please let me know. I'm going to look for any comment that I see your name on. But if you can put it in the chat, I'd appreciate it. That way it'll make it a little easier. I don't see any other. So, Will, thanks so much for the super chat. If there's a ticker you want me to look at, please put it in the chat and we'll take a look. All right. So, Cartel Raider. And by the way, I like the Las Vegas Raiders. I don't know that they're going to do all that great, but I do like the Raiders. All right, Carlos. UNH dipped today. I bought shares. I think UNH is going to go to $600 a share. I've talked about that stock for the last 4 months. And yeah, we're going to have, it's not going to be a straight line, but it had a good month. It's gone up nicely since its low point, 26%. And there's just a lot of value here. And there's a lot of very well-known, respected investors that jumped into this stock. Warren Buffett doesn't get any better than that. He jumped in. Michael Burry, super famous. He jumped in. David Tepper, that guy's killing it. He's number 2 on my stack rankings. Killing it. And by the way, he's the owner of the Carolina Panthers. He's made so much money. He is owner of a football team. So did you see where Trump or RFK going to stop the COVID vaccine in a few months? That's going to affect Pfizer. And what was that other company that had the vaccines? I didn't see that, but I don't think it's high volume for those companies anymore. I don't think they're going to lose a lot of revenues. So, hey, Will, thanks so much. I appreciate it. Just everybody, the gesture is really, really appreciated. Thank you. Yeah, so we'll see where United Healthcare goes, but I think the night belongs to small cap software companies. The queen of the ball is MongoDB. Look at that. 30%. Nicely done, Mongo. $17.5 billion market cap. I think it's priced too high, but hey, I'm going to let them enjoy the night. Pretty soon they're going to be fairly priced. Keep in mind, like Mongo, who do they compete against? Well, let's just start with the biggest software company in the world, Microsoft. It's like, oh my God. It doesn't get any harder than that. It's like, you're going to compete against Microsoft? Yeah. All right. Good luck with that. And they have a list of other competitors. So it's going to be a tough road, but their revenues were good in the quarter, 20 some odd percent. See here, 23.7% in the quarter. And the trailing 12 months, 22%. So nicely done, MongoDB. And this is kind of spilling over to some other companies like GitLab is up nicely because I think investors are seeing that, hey, these small software companies, there's some money there. So hopefully it causes a positive kind of sentiment around smaller software companies. All right. Yeah, I appreciate that, Cartel Raider. Really appreciate that. Thank you, sir. Eli. I did look at Grab. We've looked at it a few times, and Uber owns part of Grab, by the way. And Grab doesn't have the same fundamentals as Uber. I still like Uber way ahead of Grab. And when you own Uber, you own a part of Grab. Uber owns a good number of shares of Grab. And let me make sure I'm talking about the right company here. Is Grab the delivery company? Yeah, I'm talking about the same company. I have the valuation in the repository. If any of the members, you can check out Grab. People are interested in Grab because they think it could be the next Uber, and I understand the logic. But the discount on Uber is better than these guys. Uber's discounted by 50%. I'm a big Uber stockholder. And I already own part of Grab because Uber owns 20% of the shares of Grab. Grab's way over in Asia. I love Asia. I own Chinese stocks. These guys, neat little company, but my money is with Uber. Thanks for asking. All right, guys. So tomorrow I'm going to stream with Daryl in the morning. So you get the duo looking at fundamentals, and then he looks at the charts, and then 4 p.m. Eastern is the main event. We're talking NVIDIA. We're going to see where the earnings land, what their growth is. I'm going to forecast their free cash flows, their earnings per share, revalue the company, and then Daryl's going to take us through charts. I think he has invested in and out of NVIDIA successfully, and I think he has a lot to say. So tune in to the watch party, 4 p.m. Last time we had over 1,500 people on that live stream. The chat was going crazy. So if you join tomorrow and I'm a little slow on the chat, you'll know why. We'll have like 100, 200 messages in there. But if you're a member, it highlights your name, and I'll be able to go to you. So, all right, guys, cool stream. Thanks. We had a lot of attendees for an evening session. That's awesome. Thanks a lot. And tomorrow's an exciting day. Let's see what happens tomorrow. Look forward to it. And we'll see if my expectation that NVIDIA will sell off and after hours happens, or if we'll all have a good laugh. At least I'll laugh about it. All right. Thanks, Carlos. See you guys. Cartel Raider. Thank you, sir. Will, thanks again, sir. And Shadow Guy, if you're still out there. Mike, if you're still out there. Thank you for joining. Thanks, guys. And have a good night. Good luck tomorrow. Brandon, if you're still on, have a good night. Thanks for asking about Stryker. And hope you guys have a good night. Look forward to seeing you again on a live stream or elsewhere. Take care.